Obviously, there are winners and losers out of this. When you take a look at the prism of inflationary pressures, commodities and oil, who are the winners and who are you rebalancing away from when it comes to Asia?
Well, in general, we are a bit less positive on equities as the higher inflation will definitely have an impact on earnings growth. We also see that the supply shock that we have seen on the commodity side will weigh on global growth and therefore will also impact, of course, Asian growth. So we are shifting a bit more into countries, basically, which have more idiosyncratic factors at play. One of them is, of course, China. We upgraded China to most preferred, as we do think China is a bit less dependent on the whole energy situation currently. They're also able to maybe rebalance a bit the global market as they still are accepting energy from Russia. And then it's one of the only central banks that can afford to cut interest rates and to stimulate. Probably most of the other Asian markets will face higher inflation out of the higher commodity prices. And therefore, we do think China actually looks quite attractive at this point.
How much fiscal stimulus is really being expected out of China, though? Because I think that was kind of one of the drivers for the bull case for Chinese equities. But are we really expecting that much from the authorities?
Well, it's still a soft approach, but think about that. Tomorrow we will get more activity data, and they probably will look weak. So we have indication, particularly from the property sector, but also output, which has been relatively weak. And we just learned in the MPC that the Chinese government is setting the GDP growth at 5.5% for this year, which is actually quite an ambitious target. So they will have to start to stimulate a bit further. We will definitely see more triple R cuts. We will see credit easing policies coming through, and that should support the equity market, which is trading relatively cheaply versus some of the other global peers, but even versus some of the Asian peers.
Yeah, in fact, we've just heard from the China Securities Journal today citing analysts that China may be cutting the triple R and interest rates as well in order to stabilize growth. But Adrian, let me talk to you about your least preferred market, according to your notes, Malaysia. I'm very surprised at that call, given that they're a net oil exporter.
Absolutely. The issue with Malaysia on the equity side is, while they probably benefit economically because, as you said, they are a commodity exporter, it's very hard to find anything listed on the stock market. So if you look at basically on the stock side, there's actually a lot of pandemic winners, like glove makers, for example, and they are suffering in this environment where we see reopening up, we see higher inflation. And so the issue with Malaysia is really that the good part of the economy is not listed at the stock market, so you can't benefit when you basically buy this market. And actually the opposite, Malaysia tends to suffer from higher interest rates in the US, and therefore we actually downgraded Malaysia at this point.
When it comes to the Fed hiking rates this week, who are the most vulnerable across Asia in terms of their markets, especially when it comes to perhaps valuations also being a concern?
Well, we do think it's more the smaller countries, particularly those that have more fragile currencies. It's Indonesia, it's the Philippines. So historically, these two markets next to Malaysia have a negative correlation to higher US interest rates. And these are the markets you probably have to watch out. Should not forget, most of the investors, including most of our investors, are basically looking at Asian markets in US dollar terms. So the currency factor plays a crucial role. And we do think that they actually have some weakness probably on the currency side.
I keep hearing that given the rise in commodities, some of the best consensus calls seem to be on the commodity space. But given this spike, what about the energy transition and perhaps some of those calls that we have seen already in the past year, and especially during the pandemic, in terms of renewables and green stocks?
I think you have a bit of a barbell strategy at this point. We have basically an undersupply on commodities, and we have an underinvestment on commodities. So over the next few years, we will see that some government probably have to backtrack a little bit, support also more the fossil fuel industry and have more investment. So we're actually quite bullish on that part. But at the same time, to get independent, particularly for European companies and European countries, to get independent from Russian energy, you have to basically accelerate this transition to green energy. So you have to find additional supply of energy, and that is in the green space. So it's definitely a very interesting secular topic, and I don't think it's at all a topic that you should neglect. Actually, you probably find good investment opportunities over the next couple of weeks, and that's definitely something we're looking into and gradually adding some of these positions.
Adrian, we're getting that Treasury 5-year yield topping 2% for the first time since May 2019, and it comes as we've seen Treasuries falling right across the curve, with that 10-year yield topping now 2% for the first time since May 2019. And we are seeing that really across the 5-year yield, climbing 5 basis points to 2%, 2-year also up by about 4 basis points to just under 1.8% as well. This is part of our question of the day as well on the MLive blog, which is how does a Fed rate hike potentially affect assets, including rates? Have we, at this point, kind of positioned well enough for what a 25 basis point might do to across asset classes?
I think lots of uncertainties, of course, and the Fed is in a difficult position as inflation will stay high and probably be stickier than we originally expected, and the Fed originally expected with the ongoing war in Ukraine. At the same time, the higher energy prices will be a growth dampener, and therefore maybe eventually the Fed has to do less. So what we think is that the 10-year Treasury probably have to go higher because inflation probably stays more elevated for a longer period. But we do think that the shorter end maybe has priced in at this point a bit too much. So we are actually short 10-year Treasury rates, and we are long the 2-year, where we actually do think that we will see more a steepening of the yield curve if the Fed maybe acts this year a bit less than the market's pricing in, but more from a longer-term perspective that the rates actually have to drift higher, and we actually do think this will be represented in higher 10-year Treasuries.